Good morning, all of you. Good morning.
Good morning, sir.
Thank you. Uh, Welcome back. Today we are going to discuss on accounting theory construction. So, we discuss some introduction about today's session. Right. So it is useful to study and assess how accounting theories are constructed. So today's sessions is going to discuss about how accounting theories are constructed and from which you can learn how the accounting theories are constructed, and you're able to assess the different type of accounting theories. Some useful types of accounting theory constructions are there are many ways of constructing accounting theory, but we are going to discuss, we are going to limit our discussion on these four methods. These are the typical methods discussing under the theory development in accounting. First, pragmatic theories. In the previous session, we have already talked about a little bit about pragmatic theories. In pragmatic approach, pragmatic mean practical approach, practical. Likewise, the same principle will be carried forward here is pragmatic theories. And syntactic and semantic theories. So these terms may be new for you. Anyhow, I do my best to explain the things. Normative theories and positive theories. So these are the four types of accounting theory construction will be discussed in today's session. And we touch the accounting timeline, how the accounting theory is evolved over the period of time. In the pre 1414s, right? The practice is a before 1400 years, right? In year 1400, before that year, so accounting is practiced. So they are developing. They develop. It was a practice development period. In 1400, so they are pre-theory period. So in this period, there's no theory. So that's called pre-theory, before theory period. Continued development of practice. And 1700, especially the period of 1750 to 1920s, formalization of practicing, right? The formalization of practice. No theory actually, they are formalized, they standardize the accounting practices. 18th and 1955s, the general scientific period. So the golden age of science. You can find there are so many inventions in this period. Like science in accounting also, they try to give scientific background in developing theories. So explanation of practice and development of explanatory framework. They start giving explanation for each and every actions, each and every practices in accounting. So they are trying to provide explanatory framework. 90s, especially in the period of 1956 to 1970s, the normative period. Normative period, so a statement of ideal practices, basis for achieving such practices. So we'll discuss later on today's session about normative period, normative approach, normative theory. Right, sorry for the interruption. Right, in 1970s to 2000, so positive accounting theory is a new concept. So positive accounting theory, a framework to explain and predict behavior. And present days after 2000 to present days, mixed development, positive and behavioral theories. Let's start from pragmatic theories. Pragmatic, it's a practical theory, practical approach. Practice. The theories develop on the practices, best practices. So pragmatic approaches are based on observing the behavior of accountants. How this theory is developed? First, observe what accountants do, how accountants behave in a particular circumstances. The pragmatic approach are based on observing the behavior of accountants or those who use the information generated by the accountants, right? Either two way. One way, observing the act practices of accountant or the output of accountant, how they generate information, how the use of information generated. So the report, how the report works, how the report behaves, what kind of information it generates. So these things are will be observed in pragmatic theories, right? Pragmatic approaches are based on observing the behavior of accountant or those who use the information generated by the accountants. Either side, right? Accountant's point of view and users point of view. Users mean who? So the stakeholders, right? Stakeholders. It may be this investor, shareholder, and investor, competitor, like that. So how they interpret, how they use the accounting statement, financial statement, both sides, right? Accountant perspective, how the accountant behave, how accountant practices, that is one side. Another side, how the uses of that accounting information, uses of accounting financial statements are behave, both sides. First, so based on this perspective, accountant perspective and psychology, accountant perspective and the user's perspective, it can be divided into two. First one, descriptive pragmatic approach. Descriptive pragmatic approach. This is basically accountant's point of view, how accountants are behave. The second one, psychological pragmatic approach, here in the point of view of users, users of accounting. Now, descriptive pragmatic approach. So this is inductive approach. In the last session, so we have discussed a little bit deeply, uh, inductive, deductive. Right? Inductive, it starts from the observation. From the observation, we find a common pattern, a theme. From that theme, they develop a hypothesis and they develop a theory. This is inductive, right? So hence a theory can be developed from observations. The theory can be developed from observations of how accountants act, how accountants behave, how accountants are practicing. So observing how accountants act in certain situations. When do depreciation, when they calculate depreciation, how they behave. When they do calculate goodwill, how they do. Right? When they are preparing financial statement, what they are do, how they are do. Right? How they record transactions, how they record sales, how they record sales purchase, credit purchase. Right? So this kind of practices, observing accountant, how accountants are practicing. The theory can be tested by observing whether accountants do, in fact, act, whether accountant act, behave in the way the theory suggests. You observe hundreds of accountants' behaviors. Based on the accountant's behavior, based on the observation, you have you can understand. So this is how the accountants are practicing. Based on that assumption, you can apply to others. You learn. So training, no, when you are getting training, so the trainer will train you. You observe how the trainers are doing, right? With the training, you can observe many things. That is inductive, no, you observe the thing and try to apply the same thing in your work, like that. So this is what pragmatic, descriptive pragmatic approach, observing the behavior of accountants. From that observations, you form a theory. That's called descriptive pragmatic approach. According to Sterling, it's an anthropological approach. Anthropological approach. However, there have been several criticism of this approach of accounting theory constructions. How do they develop theories? Based on the observations of accountant, how accountants are doing the things. Based on that, you develop a theory. So what are the criticisms of this descriptive pragmatic approach? First, no analytical judgment of quality. No analytical judgment of quality. You just observe. Many people are doing, therefore I am doing. Many people are practicing this, therefore I am practicing. This time here there is no space whether it's correct or not, whether it's quality or not. There's no quality judgment. Many people are practicing, like therefore we practicing. This is what analytical judgment of the quality. No analytical judgment of the quality. Second one, it does not allow for change. It does not allow for change. Many people are doing. So why do I want to go for new thing? I also follow others. Right? This is the argument. There's no change, no new things. Whatever the things practiced by other accountants, former accountants, sometimes you may get training from the chief accountant. You that time you were worked as training, accounting training or accounting clerk. So once you get the position of chief accountant after the retirement of existing chief accountant, what will you practice? The same thing. Same thing you will practice. You don't want to change. You don't want to add new things. No, or less focus on the attributes of the firms and their diversity. No. So you may get training from manufacturing industry. Now you get the job in service industry. So you try to apply the same thing practiced in the manufacturing sector in the service sector based on your account, based on your experience, observations. You try to adapt the accounting practices based on your observations. So these are the criticisms of descriptive pragmatic approach, right? So what are the criticisms? No analytical judgment of quality. It does not allow for change. No or less focus on the attributes of the firms and their diversity. These are the criticisms. Now we'll move to the pragmatic approach. So theorists observe users' response. The descriptive pragmatic approach was focused on observe on accountant's practice, how accountant behaves. Now in psychological pragmatic approach, it focused on responses of the users. Theorists observe users' response to the accountant's output, such as financial report. Once the accountants prepare financial statement, users will take the statements and try to interpret in different ways based on their understanding, based on their own interpretations. So psychological pragmatic approach observe how the users are interpreted, how the users are react, respond to that financial reports prepared by the accountants. The usefulness of information in financial statements is judged based on the reaction of users, right? So usefulness of the financial statement is judged based on the reaction of users. If all users are react in same way in positive manner, all the users are accept these statements in a positive manner, yes, they can finalize, they can make theory, yes, this is the best way of accounting, this is the best way of preparing financial reports, this is the best way of reporting financial events, this is a way of accounting. But the problem is illogical, irrational reaction of users. Illogical, irrational reaction of users. Sometimes uh, the users may does not have enough knowledge on accounting. They don't know how accounting mechanisms are work. So they just look on the profit. They don't want care about other things, right? So there are many logically rational uses. So the thing is, sometimes the actual things are there, the fact is there, but the users are interpreting wrong way, right? So this is the problem of this psychological approach, users point of view. And preconditioned response, sometimes the users, the owner may have a bad opinion on the accountant. All the times he has all the times he is criticizing the act of accountant, even though the accountant do the best thing, do the thing correctly, the users always criticize him. All the times he try to blame, right? So this kind of preconditioned response. So based, so if the observer observe this preconditioned irrational uses, their conclusion, their theory development will go in wrong direction. So these are the uh, criticisms, problems of psychological pragmatic approach. Others may not react when they should. Others may not react, right? So just read the information, no reaction. So these are also a problem, right? Now we move to the most important thing, and it seems it will be difficult to understand the things, right? Right. syntax and semantics. So why do we discuss this thing? So it is an accounting, right? Accounting theory based on this concept: syntax, semantics. Syntax mean, you know, some kind of signs, right? Road signal. So it's called syntax. So you can find a lot of signal syntax in mathematics: plus, minus, right? Divide, star, greater than, less than, equal sign. So, and in computer science there are different, and you can find so many flow charts. So syntax. In accounting we also syntax. No, we use A for asset, L for liabilities, E for equity, this kind of syntax, right? And EPS, DPS. So these are the EPS. You can explain, you can understand what do you mean by EPS, but others people, it's difficult to find. It is difficult to understand what do you mean by EPS and DPS. These are the syntax. And semantics is a meaning, right? I can explain this thing using this small example. So traffic light situation, right? A syntax, semantic and pragmatics. So you know, so the red, blinking red, it's a syntax. Blinking red syntax, blinking as yellow and green. These are the syntax. No, syntaxes are green, yellow, red. Syntax. So what the meaning when red blink? We have to stop. The meaning mean the semantics. So when green lights blinks, its meaning you can go. In case of red is blinking, you have to stop. Yellow, get ready, isn't it? So these are the meaning, the difference between syntax and semantic. Syntax has meanings, that's called semantics. And practice, pragmatic. What's the practice? The actual meaning of the red, you have to stop. But if red and no traffic, red is blinking, but there's no traffic in the road. So what do you decide? There is no traffic, there is no police, there's no camera on the signal. So what do? Then you're allowed to go. So this is a practice. So we forgot about pragmatics. So we are focusing on syntax and semantics. Syntax are the signals, semantics are the meanings. You see, loan balance formula. PV equal PMD into 1 minus 1 divided by 1 plus I to the power n divided by I. So what do you mean by this? The syntax we can understand, but many non-accountants unable to do so. Syntax. So this is the meaning of this. PV mean loan balance, PMT periodic payment, I is a discount rate, N is number of periods remaining. So this one is a syntax. So this thing is a meaning. Now we come to the session. Syntactic mean it's the syntactics, the words come derived from syntax. Syntactic and semantic theories. Theorists evaluate different accounting models based on their syntactic and semantic elements. They develop accounting theories. Theorists develop accounting theories based on syntax and semantics, signals and the meaning. You know, historical cost accounting. What do you mean by historical cost accounting? For example, if you purchase a machine, for about 1 million 10 years ago. 1 million 10 years ago. But the market price is 5 million today. Even though, based on the historical accounting perspective, we have to record the asset at the original value. That's mean 1 million rupees. We don't worry about the current market price. This is for example for historical accounting, historical cost accounting. Historical cost accounting is syntactic theory, then semantic theory. So confusing, no? Historical accounting theory is syntactic theory, than semantic. Why? Why we say it's a syntactic? Forget about. So the vouchers, journals, ledgers of the business, it has meaning, right? Voucher, if you take the voucher, you can understand. It gives the actual value of the machine. You see the journals. The vouchers will pass to the journals, a journal pass to the ledgers, and ledgers pass to the accounts. Accounts mean statements. So voucher has meaning, journal has meaning, ledger has meaning. So therefore it called semantic. Inputs are semantic. It has meaning. Premises and assumptions of historical cost accounting. For example, inflation. In historical accounting, we not consider inflation. We not consider about inflation. Premises and assumption of historical cost accounting, example inflation, is not to be recorded and market value of assets and liabilities are ignored. It's mean what? Early inputs, the voucher, journals are the inputs of accounting. But when they record, they forget about inflation. So normally historical cost accounting, we always we ignore the inflations. Accountants are audited. Accounts are audited just for any errors in calculations and manipulations. No pragmatic test or semantic test. They record the transactions based on the vouchers. They are prepare the financial statement based on the journals and ledgers. Inflation is the most important factor, but most of the times are ignored. It does not reflect the current state. It not reflects current situation of the value of the asset. So it does not have meaning, right? Syntax. Historical cost accounting is syntactic theory than a semantic. The auditors are checking the accounts whether they prepared the accounting based on their evidences, based on their source documents. Some accounting theorists are critical on this approach. They argue that the theory has semantic content only on the basis of inputs, on the basis of its input. The ledgers, vouchers, these are the things. These are the inputs. These input only have the semantic content, meanings. There is no independent empirical operation to verify calculated output. For example, profit or total assets. These figures are not observed. They are simple summation, the total of account balances. and the auditing process is essence simply recalculations. Auditors come and check whether whether the things are correct. It means the calculations are correct. Recalculations. So non-accountants, the people does not have accounting knowledge, do they able to understand the financial statements? Do they able to understand the financial statement? It is difficult. It is difficult. So it's like a syntaxes. It's like a syntax. It does not give any meaning. But if anybody see the voucher, it's a meaning. It has a meaning. Auditing process verifies the inputs by examining underlying documents and check mathematical calculations. What auditors do? They check the source document and they check, is it correct? They verify the inputs by examining underlying documents. They are focused on evidence and they ensure that the documents are prepared based on the evidences. However, it does not verify the final output. This means that even if accounting reports are prepared using perfect syntax, they may have little, if any, value in practice. So they are giving numbers. Auditors are checking whether the calculations, evidences are correct, the syntax based. Historical cost accounting has also been criticized on the basis of syntactic element because most of the time it ignores inflation's current state. Example, the sum of two weights means nothing unless they are measured by the same rules. Now we move to the normative approach, normative theories. Normative. So it all the times argue with right or wrong. And it explained this is the only way to do that. The 1950s and 1960s show what has been described as golden age of normative accounting research. During this period, 1950s to 1960s, normative accounting research emerged. Normative accounting theories are emerged. This period is called as golden age. Normative theories are prescriptive and value laden in nature. Prescriptive. They already put an order. This is the way of doing the things. Prescriptive, right? Prescribed. So for example, so if you go for doctor for medical advice, medical consultants, he will diagnose you and the doctors will give you a prescription. Prescription is what? It's an order to the pharmacist. We just submit the prescription to the pharmacist and the pharmacist should do accordingly. He cannot change himself. What doctors written in the prescription, they have to do. There's no modifications. There's no substitute. You may observe. No substitute. Do not substitute. No. So the pharmacist cannot use their own judgment. They have to obey the prescribed in the prescription. Right? Likewise, in accounting, the normative uh, theorist develop some guidelines, develop some rules as a rule of thumb. This is how you have to practice. If not, it's totally wrong. They prescribe already, set the things, set the rules. They already set the ground rule. So based on that rule, accountants should practice. Others should practice for accounting. In that way, they have to prepare accounts. In that way, they have to prepare financial statements. In that way, they have to interpret the financial statements. So this is what normative theory is. Normative. So that's what we are practicing. We follow accounting standard. This is prescriptive. Framework, it's a prescriptive. The framework explains us where we have to put sales, where we have to put income tax, where we have to put interest expenses. So it's prescriptive and value laden in nature. They have already suggested you the best way. You have to follow that way, right? So it prescribes how people like accountants should behave to achieve an outcome that is just to be right, moral, just, or otherwise good outcome, right? They already prescribed everything. So it prescribes how people, how accountants should behave to achieve when an outcome that is just to be right. If the accountant deviate from that rule, that prescription, they are wrong. Accountants are wrong. You know, if you are not followed SLAs, LKs, then you will be wrong. You cannot apply your own judgment on accounting. So that is normative approach, normative theory. Normative theorists adapt an objective, ideal state, and then specify the means of achieving the stated objective. Right? The, the normative theory explains what's the objective. The objective of the statement. Say, for example, income statement. The objective is what? Explaining give information regarding the performance of the company. Profit or loss. To calculate profit or loss. It's the objective of a income statement. So it explains how you have to prepare the accounting statements, how you have to prepare the income statement to achieve that objective. It explains the way also. How do you have to prepare? How do you have to do that things? What are the steps you have to follow? These things already prescribed. They provide prescription for what should occur to achieve their stated objective. So that's why we can find accounting framework. We will discuss it later, forthcoming chapters. Accounting framework. You know how to prepare trading account, how to prepare income statement, how to prepare manufacturing account, how to prepare balance sheet. So these things already explained. You have learned. You have learned the best ways. That's what normative theory. Normative. You have learned. You have in your hand that frameworks, that standards because of normative theories. It emerges in 2000s. Normative, the ideal way. This is the best way. Two groups dominated the normative period. The critics of historical cost accounting, right? Historical cost accounting mean what? Yeah, in syntactic and semantic. So they are criticized that thing. And conceptual framework proponent, right? They criticize historical cost accounting and they propose conceptual framework. They propose conceptual framework. That's what we are using, conceptual framework. The conceptual framework explains us what is income, what is expenses, what is asset, what is liability, what is sales, what is cost of sales, what is gross profit, what is net profit, what is admin expenses, what is selling expenses, what is finance expenses. Everything is explained in conceptual framework. This conceptual framework will guide you. You can find this conceptual framework in IFRS, International Financial Reporting Standard, and Sri Lankan Reporting Standard, SLFRS. It will guide you. Because normative accounting theories prescribe how accounting should be practiced. You know, how accounting should be practiced. There's no option. You have to obey. You have to follow that. They are based on opinions of what accountants should report and the best way to do that. It explains the best way to do that. Opinions as to appropriate goals and methods of accounting vary between individuals, and most of the dissatisfaction with the normative approach was that it provided no means of resolving these differences of opinion. For example, in the framework tell you that for depreciation, straight line method is best method. Straight line method is best method. But in your opinion, no. Number of production units, calculating depreciation based on the number of units is the best way. Your opinion. It seems good. It seems appropriate. In this current period, in pandemic, many manufacturing organizations are not operating, but already almost 1.5 years has passed, gone away. There is no production. So is it appropriate? Is it appropriate to provide a depreciation for that period also? No? So if we apply straight line method of depreciation for the situation, it is irrational. But framework will not allow you to do so. The framework says, for example, you have to follow straight line method, but your individual opinion says it is not good method. The best method is depreciation based on number of units, but normative theory not allowed to do so. So you may dissatisfied on this approach, these theories. So there's no space for opinions. Two major criticisms of normative theories. Normative theories do not necessarily involve empirical hypothesis testing. It not allows for empirical hypothetical testing. You can right empirical hypothesis testing. Normative theories are based on value judgment. Based on value judgment, these are the uh, criticisms of normative theory, right? Further, underlying assumptions of normative theories were untested, and it was unclear whether theories had strong foundation or assumption about purpose of accounting. Sometimes it does not have any strong foundation behind. Sometimes it has no logic behind the accounting practice. So practically, it was also difficult to obtain general acceptance of any particular normative accounting theory. So it has also problem. So normative theories in this period concentrated either on deriving the true income profit for accounting period, or on discussing the type of account information which would be useful in decision making. Now we move to present theory, that is positive theories. Normative From normative, it shift to positive theories. Positive theories, all the times they asking question why. Why do I have to follow this? What is the reason? How it works? What's the logic? But normative theory says yes or wrong, do or die. Only two options, yes or no, right? When doctor gives a prescription, if you submit the prescription to the doctor, so into the pharmacist, if medicine available, they will give. They can't suggest alternative one. Pharmacist unable to suggest alternative to the prescription. If they have the medicine, they can give. Otherwise, they say no, yes or no. That is normative theory. But the positive theory, it explains why. If doctor prescribes a medicine, the question will be asked, why? Why we have to take this medicine? What is the reason? Right? So this kind of things, asking more questions. Why? Why I have to follow this? Not an order. Positive theories not give an order. It gives spaces for asking questions. Why? Positivism or empiricism means testing or relating accounting hypotheses or theories back to the experience or fact of the real world. Empirically testing some of the assumptions made by normative accounting theorists. Empirically testing assumed importance of accounting output in the marketplace. Today, great bulk of positive theory is concerned mainly with explaining. Now the theory has come to explaining why, explaining the reason for current practice, predicting the role of accounting, and associated information in economic decisions of individuals, firms, and other parties that contribute to the operation of the marketplace and the economy. Right? If you are not satisfied with storyline method, and if you suggest uh, depreciation based on the number of production units, you can ask, you can explain. So why it is suitable, why that practice is not suitable, why the straight line method is not suitable, why reducing, why number of units method is suitable. You can explain. If anybody force you, you can ask, can you tell me the reason? So this is how you can ask, and it will predict you, right? So in normative approach, the the regulators will force you, but in positive theories we can contribute for the theory development, economic theory development. You can give a rational ideas, rational judgments. So which, for example, which firms are more likely to use straight line depreciation rather than diminishing balance depreciation, and why? It gives some spaces you can choose. Why firms report their fixed assets at revalued amount? What are the impacts? They are not relies on historical cost. They rely on, okay, if you wish to disclose your assets, fixed asset in current prices, current market prices, you can do so, but you have to give explanations. You have to give some rational judgment. You have to give a logical reasoning. Main difference between normative and positive theories is that normative theories are prescriptive, give order, whereas positive theories are descriptive, describe the things, describe the reasons, explain why, describe the situation. If you suggest new thing, you have to explain why. Or predictive, you can predict based on the current situations. So positive theories give space for that, but the normative approach you can't do so. Positive theories do not prescribe how people, like accountant, should behave to achieve an outcome that is judged to be good. It is not judge. It's based on the practitioners. It gives spaces for judgment, but they have to give description. They have to give explanations. Rather, they avoid making value-laden prescription. Here, there is no good, bad, yes or no answers. It gives explanation. You have to write lots. You have to talk lots. Describe how people do behave, regardless of whether it is right or wrong. No, you have to describe how to behave people. Explain why people behave in certain manner. For example, to achieve some objectives such as maximizing shareholders value, their personal wealth, regardless of that's right or wrong. So it does not argue, it does not give idea about what is right, what is wrong, what is good, what is bad. It not gives that kind of idea, but it gives space to explain why we have to follow this theory. Why do we have to follow this standard? Why do we have follow this method? This kind of things. And you can justify why do I follow this as an accountant. Predict what people have done or will do, again regardless of whether that's right or best behavior. Many positive theory researchers are largely dismissive of normative viewpoints. No, uh, positive theorists blaming normative viewpoints. Normative theorist. No, the positivist theorist blaming normative people, normative theorist. Again, normative people also blaming positivist theorist. So similarly, many normative theorists do not accept the value of positive accounting research. In fact, it means positive theorists and normative theorists are blaming each other. They argue that our viewpoints are good, our viewpoints are better, this kind of arguments. But in fact, theories can coexist. Both theories will be exist in the same time and complement each other, right? You cannot say I am positivist, you cannot say I am normative, but the fact is both should be exist, coexist. Positive accounting theory can help provide an understanding of the role of accounting, which in turn can form the basis of developing normative theories to improve the practice of accounting. So for the further reading, you can get accounting theory, Giant Godfrey, Wiley publication, chapter 2, accounting theory constructions. So this is the end of the session.